I have a new screencast app, and let's see how it works. Let's do a net present value calculation here. We have this page from the text. I brought up the ebook, page 84, I think it is. Anyway, we have the definition of net present value, and that is simply the sum, that's what the sigma is, from time period 0, which means today, and the default is stepping by 1. Today, next year, the year after that, etc. If we have 3 years into the future, big T would be equal to 3. If we went 2 years out, it would be 2. If we went 10 years out, it would be 10. All right, and then we're going to take this delta to the T power. And delta is our discount factor, which is 1 over 1 plus the discount rate, R. And we're just going to raise that to whatever power T is for each item. So the first item is T equals 0, so 1 over 1 plus R to the 0 is just 1, right? Anything to the 0 is 1. And then we multiply that by this IT, and IT is short for BT minus CT, the benefits in period T minus the costs in period T. The key thing to know there is that costs enter as a negative. So let's just make an example up. I have an untitled spreadsheet open here. Just went to Google Drive and created it. Google Drive looks like that. You go to this new and you can select Google Sheets, and that's what I did to get this. So let's label period, and let's keep track of the benefits in period T, the costs in period T, and then the net benefit. Net benefit would be just the benefits in period T minus the costs in period T. And it's this bottom item that we want to discount. Well, we want to discount when it's necessary to. We don't have to discount in this first period, this period 0, that's today. Next year, period 2 is the year after that, period 3. And let's do a period 4, what the heck, you know, it's the spreadsheet. Spreadsheets make things very, very easy. And let's follow the example in the text, and we'll think about some endeavor that costs a lot up front and then turns into this revenue stream after that. And we'll have a four period life, so each period is a decade or whatever. You know, hopefully it's more than that, a decade after your med school anyway. So let's say you got to shell out $500,000 in period 1. I'm making these numbers up and talking and typing at the same time. So you have to shell out a big expense to all, you know, the equivalent of 4 years tuition packed into 1 period's worth. Very accelerated program, no sleep. And working at double speed. And then let's say after that I'm making these numbers up. Let's say you make $200,000 a year the first year, and then let's just say you get what would be a good raise? Let's say you get a 10% raise every year, and I'm going to do this by taking whatever your income was the period before, and I'm going to multiply it by 1.1. That's 10% you had, which you had before, plus 10%. And then let's just copy that across. And with 4 periods, it's not too hard to type out, but you could see how convenient a spreadsheet is when you have a lot of periods. And now, this, we tell the computer that we're going to get a formula by putting in equal signs there, and we're going to take the difference between whatever benefits, and as I mentioned last night, if you don't have anything, it just assumes 0, minus whatever costs in that period. That's all we're going to have to do. And then we can just fill that across. And this is the undiscounted stream, but it's important to discount because, as I explained, $1 today is worth more than $1 tomorrow, and if we're comparing different opportunities, we want to be comparing those opportunities in the same units, and we do that by converting everything to today's dollar. So I'm going to call this the discounted stream, and then I'm going to put a total over here, so that'll when I get to the total of the discounted stream, that's going to give me that net present value in the formula. So here I'm just going to do our formula. Let's say interest rate is 7%. So R equals 7 percent, which of course is equal to 0.07. Those two numbers are equivalent. I'm just saying 7% just to give you a different example. That's an awfully high discount rate. We do this in real terms, net of inflation, and right now real interest rates are very, very low. This is somewhat of an exceptional period, but in the long term, we'd think 2-3% range for real interest rates. But let's just use a discount rate of 7%. It's just an illustrative example, not anything we're going to have to defend as realistic. All right, so we go this discounted stream for every term, for every net benefit term, we're going to divide it by the discount rate, 1 plus the discount rate, so that's 1.07. We're going to take that up to the power of whatever period it is. That was that t. And so it's 0 at the beginning, but then it goes to it goes to 1, 2, 3, 4, and then 4 finally. I'm just pulling that formula to the right. So what a spreadsheet does is it just takes that formula and applies it to the values that have the relative position as the cell in relation to the new cells as those values did in relation to the place where you entered the formula. So it's taking the value right above the cell, dividing it by 1.07 to the power that's 4 cells up, 4 rows up. And then if I want to sum that to get net present value, I simply go sum, and then you take the beginning value, shift, and the end value, and parentheses, done. So this opportunity to become a physician according to these discount rates nets you almost 300,000. The discounted benefits in excess of costs is about 300,000. One thing to notice is watch how much values change. Let's say new discounted stream, and let's say we're going to do it at R equals 10%. which of course is equal to 0.1. That's really high, but what I wanted, that doesn't look like that big of a change, but I'm going to guess that when we impose that change in discount rate, we're going to get a much lower value, and it's because we're discounting these future earnings more heavily when we do it this way. But let's just see. Let's put in a new formula. Let's tidy up here. I'm going to want that to be a little wider. So the discounted stream, I'm going to take this undiscounted term, and I'm going to discount it 1.1 now to the power of the period in which we are. And of course that first value is not discounted at all, but then by the time we get 4 years out, we get quite a different number because we're discounting more heavily. And I can just copy that formula and paste it below, and lo and behold, we've got quite a drop. It's 225,000 roughly, not 300,000. So let's call that good enough for this example.